This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, June 29, 2026, and this is the Tokyo session. Now, let's get into it. Fear is at a 12-month low, but the dollar is at a 12-month high. The Fear and Greed Index has collapsed to 14 out of 100, signaling extreme caution, yet the VIX remains suppressed at 18.41. We are looking at a market that is terrified of the future but complacent about the present, with the US dollar pushing dollar-yen to 161.7945, and gold holding steady at 4,065.89 as the only real ballast in a turbulent regime. As of 1912 ET on June 29, 2026, we are entering the tail end of the Asian session and pre-market prep for the US. The calendar is quiet on the macro front today, but the next 48 hours hold the keys to the current regime shift. On Wednesday, July 1st, the ADP employment report drops, followed immediately by the GDP Now estimate. Both are high-impact releases that will test the resilience of the higher for longer narrative. Then, on Thursday, July 2nd, non-farm payrolls and weekly jobless claims take center stage. With the yield curve flat and inflation sticky, these labor numbers are the pivot point for the Fed's next move. Apex, how does this calendar interact with the current positioning?
The calendar is secondary to the positioning. The ADP and non-farm payrolls data won't just confirm trends, they will trigger mechanical reactions from the 97,092 net short yen position held by leveraged funds. If Thursday's non-farm payrolls misses, we don't just see a dip in dollar-yen, we see a forced covering event that could bypass standard technical support. The data shows the market is already priced for a hold, so any deviation is a catalyst for the squeeze I flagged earlier.
Let's look at the structural snapshot. The Fear and Greed Index is at 14 out of 100, firmly in fearful territory, yet the VIX is only down slightly to 18.41. This divergence suggests that while investors are pulling back from risk, they aren't yet hedging for a crash. The US dollar is structurally supported by a 3.63% Fed funds rate and sticky CPI at 4.17%, creating a higher for longer environment. Meanwhile, gold is trading at 4,065.89, up 0.7%, acting as the primary hedge against the bad day for Japan narrative. SPECTER, this suppression of volatility alongside extreme fear is unusual. Is this a calm before the storm?
It is a dangerous calm. The VIX is trapped in a 5-day range of 16.49 to 20.72, and it is currently at 18.41. That low level indicates complacency. Investors are scared enough to buy gold and dollar, but not scared enough to spike the VIX. This creates a fragile environment where structural leverage, specifically that massive yen short, can accumulate unchecked. If the VIX breaks above 20.72 while sentiment remains this fearful, the risk-off trade accelerates rapidly. We are not seeing a crash yet, but we are seeing a lack of insurance.
3 headlines are driving the narrative right now. First, Japan loses in the round of 32 at the World Cup. Dollar-yen ticks to 40-year high. Second, Reserve Bank of Australia June minutes eyed for hike threshold clues after unanimous hold, inflation risk live. And third, rare earths, export controls, and WTO reform headline new EU-China trade framework. CIPHER, how is the market reacting to the Japan headline and the Reserve Bank of Australia minutes?
The Japan headline is fueling the sentiment, but the flows are driving the price. Leveraged funds have added to their net short yen position, now sitting at 97,092 contracts. This is unprecedented concentration. On the Reserve Bank of Australia front, the minutes are eyed for clues, and the positioning shows a bifurcation. RC is strongly bullish at plus 39,111 net, while yen is heavily shorted. This creates a structural carry trade dynamic where RC yen is a critical indicator. The market is betting on the Reserve Bank of Australia staying hawkish, while the BOJ remains dovish, but the sheer volume of yen shorts makes this trade vulnerable.
And the EU-China trade framework.
That is impacting euro positioning. Euro leveraged funds are net short 15,410 contracts, while DXY funds are net long plus 4,438. The market is rotating specifically into the greenback, not just broadly into risk-off assets. The EU-China news is adding noise, but the smart money is clearly favoring dollar over euro right now.
Let's go straight into the pressure cooker, dollar-yen. It is trading at 161.7945, up 0% on the day, but sitting just 15 pips below its 5-day high of 161.95. Grid, you flagged this level as a structural barrier. What does the chart show?
The chart shows a lack of conviction to break 161.95. Dollar-yen is trading at the top 90% of its 5-day range of 161.532 to 161.95. We are seeing compression. When price sits at the very top of a tight range with high volatility expectations, it usually means the upside risk is exhausted. The data shows no signs of a violent reversal yet. But the technical exhaustion is real. The 161.95 level is a binary trigger. A failure to hold here invalidates the bullish structure, while a sustained break requires volume confirmation to avoid a false breakout trap.
I have to challenge grid focus on the technicals here. You are treating 161.95 as a standard resistance level, but the COT data shows a 97,092 net short position. This is not just a technical barrier, it is a liquidity trap. The risk is not just a technical break, it is a mechanical forced buying event due to the sheer volume of leveraged exposure. If that level breaks, it won't be a slow grind. It will be a squeeze that bypasses standard technical support levels.
Exactly. Grid sees a ceiling, I see a pressure cooker. The 97,092 short position means that any break above 161.95 will trigger mechanical buying from leveraged funds. The flow dynamic suggests a potential short squeeze breakout rather than a standard rejection. The technicals are secondary to the positioning. The market is priced for a trend, but the positioning itself is the primary risk factor.
And that trend is fragile. The 10-year, 2-year yield curve spread is flat at plus 0.28 pp, which signals underlying growth caution. While the dollar is strong due to policy divergence, the flat curve suggests the fundamental support for a continued yen slide is weakening. A short squeeze is not just a technical risk. It is a fundamental correction to mispriced rate differentials. The market is ignoring the growth slowdown, signaled by the yield curve. So, we have a technical ceiling at 161.95, a massive short position waiting to cover, and a flat yield curve suggesting the fundamental trend is weakening. How do we trade this?
I stand by the range-bound view for now. Until 161.95 is broken with volume, the statistically probable outcome is a mean reversion pullback toward 161.532. The data shows limited room for further upside without a breakout. I am not predicting a break, I am describing the current structure. The pressure is there, but the structure is still holding.
Moving away from the yen, let's look at the other side of the coin, Aussie dollar. It is trading at 0.68889, down 0.1% on the day, but holding its ground in this risk-off environment. CIPHER, the positioning here is distinctly bullish compared to the yen shorts. What is driving this?
This is the carry trade integrity. RC leveraged funds are strongly bullish at plus 39,111 net. This contrasts sharply with the bearish Canadian dollar positioning at 83,377 net. Despite the risk-off sentiment, institutional capital is rotating into RC, likely anticipating Reserve Bank of Australia hawkishness or simply seeking yield relative to the yen. The flow data implies a structural support for RC crosses, even as equities struggle. The data shows that smart money is not fleeing risk assets entirely. They are rotating into commodity currencies that offer yield.
Technically, Aussie dollar is range-bound, trading within a 5-day band of 0.68754 to 0.69275. It is currently at 0.68889, which is near the lower end of that range. The data shows limited upside for DXY, which indirectly supports Aussie. The pair is anchored in this liquidity zone. There is no momentum to break higher, but there is no momentum to break lower either. It is a consolidation phase.
The divergence is key here. The Fed is holding at 3.63% with sticky inflation, while the Reserve Bank of Australia is eyed for hike clues. This policy divergence supports the Aussie dollar bid. However, the Fear and Greed Index at 14/100 suggests that if global risk sentiment deteriorates further, this carry trade could unwind. The data shows strong bullish positioning, but it is vulnerable to a sudden shift in risk appetite.
I'd add that the VIX suppression makes this Aussie positioning risky. If the VIX spikes due to a yen squeeze, Aussie is often the first casualty as carry trades unwind. The current calm is artificial. If volatility expands, that plus 39,111 net long position could turn into a dump very quickly. The data shows complacency in the VIX, which is a warning sign for carry trade vehicles.
Finally, let's look at the safe haven, gold. It is trading at 4,065.89, up 0.7% on the day. In a market with a Fear and Greed Index of 14, gold is acting as the primary hedge. Grid, whereas price relative to its key levels.
Gold is holding at 4,065.89, well within its 5-day range of 3,959.1 to 4,112.2. The data shows it is acting as a stabilizer rather than a driver. Key support is at 4,048.27, and resistance is at 4,075.96. Currently, price is consolidating between these levels. The data shows no breakout yet, but the proximity to the upper band suggests that buyers are defending the trend. It is a holding pattern.
The flow data supports this. DXY leveraged funds are net long plus 4,438, and Euro funds are net short 15,410. This rotation into dollar and away from euro often correlates with gold's strength as a hedge against geopolitical risk. The bad day for Japan headline is driving this safe haven demand. The data shows that while equities are weak, gold is absorbing the fear flows.
The macro context is clear. With CPI at 4.17% and core PCE at 3.41%, inflation is sticky. Gold is hedging against the reality that the Fed may need to keep rates higher for longer. The data shows that investors are using gold not just as a currency hedge, but as an inflation hedge. The fear is not just about a crash. It is about the persistence of price pressures.
And that fear is masked by the VIX. Gold is rising while the VIX is suppressed at 18.41. This is a classic sign of a market that is underpricing risk. If the VIX expands, gold could see a secondary spike as investors realize the initial calm was misplaced. The data shows a disconnect between the safe haven asset and the volatility index. That disconnect is the risk.
Let's synthesize this. Grid flagged the technical exhaustion at $yen 161.95, but CIPHER showed that the 97,092 net short position makes this a mechanical pressure point, not just a technical one. Pulse highlighted that the flat yield curve, plus 0.28 pp, suggests the fundamental trend for yen weakness is weakening, which SPECTER correctly identified as a risk to the carry trade, specifically for RC. Meanwhile, gold is holding steady as the market's primary hedge, but SPECTER warned that the suppressed VIX, 18.41, makes this calm fragile. The data shows a market that is structurally long dollar and gold, but heavily leveraged on the yen side, creating a setup where any break in sentiment could trigger a non-linear move.
To wrap up, here are the key takeaways for the Forex edition. First, dollar-yen is at a critical juncture at 161.7945, nearing the 161.95 resistance, with extreme positioning, 97,092 net short, creating a high-risk environment for a potential squeeze. Second, Aussie dollar is holding firm at 0.68889, supported by bullish carry trade flows, plus 39,111 net, and Reserve Bank of Australia hawkishness, but vulnerable to a VIX breakout. Third, gold is acting as the primary safe haven hedge at 4,065.89, but the suppressed VIX suggests this calm is artificial. For tomorrow, watch the ADP employment report on Wednesday and the non-farm payrolls on Thursday, as these data points will test the resilience of the current dollar dominance. This is ShadowQuant Forex edition, signing off. Stay sharp. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.